Okay, just going to go on to an Aussie stock, Afterpay, good old favourite, one for everyone. Um, let's have a look at this. So there's two trains of thought. There's thought one is you're an investor, and you're buying something, you're going to hold it, you believe in the company. Thought two is you're a trader. Um, if you're a trader, you can probably skip to the end of this video because this bit is really not going to be of any interest to you because you're going to be in and out. However, if you're an investor, then this is going to be quite important. Right, what you can see here is, a big move up. We're still well above the moving averages on the daily. And I mean, if you did believe in the company, this is where you wanted to buy after the March crash. Not right up here. This is just huge and insane. 150, yeah, $150 a share. This is Australia's Tesla, as far as I'm concerned, because if you go over here and have a look onto investing, right, so this is the balance sheet um, for the company. It's not looking brilliantly, to be honest. You can see here, so this here, APT, so you got the total revenues in blue and then the net income in grey. And yeah, again, not particularly fantastic, to be honest. 2020 was the first year it actually made some profit, 9.13 million, even though the total revenue was up 298. So that isn't good. I mean, okay, brilliant, making profit. It's better than it was, but being better than it was doesn't mean it's good by any means. When you're investing, you need to be thinking about what you're buying. It's not just a case of, oh, buy this stock at this price, it's going to go up. You need to have, there's a method behind it, and there's a reason why price to earnings matter. You can't just buy at any price and hope that it goes up, because if you're doing that, you're gambling, and that's not investing, it's gambling. You're just speculating on the fact that, oh, well, the share price will always go up, and I'll make money on it. There's two reasons why you should own a share. One is you buy it to receive the dividend payment, which, I mean, at the moment this company isn't paying a dividend, so that's out of the window. And then two is you're hoping for an increase in the share price, but the problem is the increase in the share price comes around because the shares are cheap. So the idea is that if you've got a company that's been making profit for a lot of time, perhaps no one's really heard about it, it's relatively new on the exchange, and perhaps you work for the company, somebody that does, and you believe in it, then yeah, okay, you can buy these shares because you're confident that that company is going to be productive, make a lot of income, and it's going to grow. And as long as it's going to grow, then you're going to make money. However, at the moment, that's not exactly happening with Afterpay. It's right the way up here. There's been very little growth. I mean, are you telling me that because it's finally turned a profit for the first time in history, it's worthy of going up from $2 a share to 150? I suspect probably not. So if you're investing, if you bought anywhere up here, then I'm not. I'd be getting rid. Honestly, I'd be selling. And I'd wait until we come back down to a more realistic level. Perhaps, I don't know, I'd have to spend a bit more time looking through the balance sheets, but perhaps if it's, starts selling at a consistent profit, somewhere around here, might be a reasonable sort of level to buy in at. But as it is at the moment, it's way too high. It's absolutely vertical. It is literally Australia's version of Tesla. Ideally, you're going to want to go back and have a look at the more reasonable sort of prices. Somewhere around here is probably going to be about right, I would have thought. And then this is where things started to pick up. So you had this initial spike. In fact, it almost looks a little bit like GameStop, where you've had this little pickup, then another pickup, and then it's gone. I mean, it did sell off in March, and then boom, off to the moon. And then just keeps going, doesn't it? And then that's your short squeeze, if you will. Perhaps that's not the case, and this is obviously of a much longer time frame. This is a couple of years, not a couple of days. But yeah, I would be, if you're an investor, I would be looking at balance sheets. So this one here, if I just go up to the top, this is investing.com. It has a lot of information on for different different companies. And you can have a look through all the balance sheet, the net income, operating costs. Because there's a lot of negative figures here. It's not particularly brilliant. Balance sheet. So there's a lot on here that you can have a look through. If you're an investor, okay. If you're a trader, however, we can go back. Let's have a look at it from a technical perspective. If we go into it, say, let's have a look at 30-minute. See where that brings us. Right, let's have a look at the 30-minute. What do we have here? So if you're a trader, you're going to be in and out. What you're looking for is just buying opportunities, basically. Buying the dips. That move like that will be good. Retest of a moving average, buy that back. Here, this would be a good one. So here, I mean, this is a reasonable sort of bet. It's gone up, it's gone down. You find this sort of consolidation zone here. This entire zone is an area where buyers are happy. And you can see here, if you go back down to this low, actually coincides perfectly with some of these peaks. So here's your support. You'll be looking here going, yep, firm of support. That's your buy. Goes back up. It didn't like the moving averages on this occasion and started to roll over. However, it did roll over with a higher low, which shows that there are more buyers in this time because it's obviously a bit higher, and it's moved. And then, so if you'd have bought in here, that was a good buy for a day trader to trade all the way up to the top. Where we're at the moment, we're a bit sort of in no man's land. We're slightly above the 200, slightly below the 100. And the moving averages have just crossed over as well, which is a bearish indication, showing that we're probably either going to head lower or at least see some sort of further consolidation. Potentially this zone's going to be a bit of support. It did sort of think about it. So if we can get to this sort of level here, wait for the 200 moving average to move up, and then potentially you're going to be looking at a move higher. Unfortunately, whether you agree with the fundamentals or not, the trend is your friend. So just stick to the trend for now. Obviously keep your stop losses in place if you're day trading. I suspect there's a lot of good reasons that things are going to start rolling over and heading lower, so I would be careful. But for now, if we can keep and hold this level, that possibly could be a good buying opportunity. But as it is now, I perhaps wouldn't buy just yet. At least see what happens on the Monday open. If it holds, then yeah, boom, give it a go. If not, stay out.